Will crypto peak in late 2025 or will it continue to run into 2026? That's the question dominating the market right now. The 4-year cycle has been remarkably consistent: December 2013, December 2017, November 2021. If history repeats, the window for a peak lands in the 4th quarter of this year. Bitcoin has already slowed after its surge, Ethereum has set a new all-time high, and altcoins are lagging. On paper, the setup looks like every other cycle top, but this is unlike any other cycle before. For the first time, institutions are driving flows through spot ETFs instead of retail leverage. Global liquidity remains strong, Powell just signaled a shift toward cuts, and trillions parked in money markets could rotate into risk assets. Stablecoin supply is still climbing, acting as fresh fuel. Meanwhile, Bitcoin's fear and greed index sits near neutral, not euphoria, and long-term holders continue distributing to new buyers. Those aren't cycle-ending signals. In this video, we'll weigh both sides: the historic 4-year rhythm pointing to a 2025 peak, and the structural changes that could stretch the cycle into 2026. With the Fed's chair transition looming, stablecoin expansion ongoing, and no signs of mania yet, the cycle may not be ready to end. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's start with the case for a 2025 peak. The idea of a 4-year cycle has become almost folklore in crypto. Traders can rattle it off without thinking. 2013, 2017, 2021. Each of those years delivered a parabolic move into late Q4, followed by a brutal reversal. The timing has been so precise that skeptics often argue it must be coincidence. But whether coincidence or not, markets thrive on patterns, and this one has teeth. Every prior cycle has been defined by the Bitcoin halving, which mechanically cuts the supply of new coins in half. Historically, those supply shocks have ignited upward momentum 12 to 18 months later, aligning neatly with the end-of-year surges. This ingrained expectation itself becomes part of the cycle. Traders anticipate it, hedge funds anticipate it, and retail certainly anticipates it. When the majority of participants are staring at the same calendar, their collective actions turn into self-fulfilling prophecies. That's why the case for a 2025 peak carries real weight. Not just because it happened before, but because enough people believe it will happen again. Of course, the crypto market is not identical across cycles, but the rhythm of psychology remains the same. Each run higher draws in new money. Each pullback shakes out doubters. As the chart climbs, more conviction builds. By quarter 4, especially in years aligned with past cycle tops, confidence spills over into mania. The altcoin market thrives during these moments, with speculative flows rotating from Bitcoin into Ethereum and then into increasingly risky plays. Even now, we see some signs of this pattern. Bitcoin has had its breakout, Ethereum is testing new highs, and many investors are already whispering that alt season is next. If this plays out once again, late 2025 would be the perfect crescendo. There is one wrinkle in this narrative that everyone in crypto has learned to respect: September. It is by far the weakest month of the year for both Bitcoin and Ethereum. Across the last decade, September has produced an average loss of around 10% for Ethereum, with Bitcoin not far behind. This seasonal weakness has less to do with on-chain metrics and more to do with global financial flows. Historically, September is when liquidity dries up, mutual funds rebalance, and equity markets stumble. Crypto, highly correlated to risk assets, follows suit. That makes the coming September both a risk and an opportunity. For traders who believe in the 4-year cycle, September pullbacks are not a reason to abandon ship. Instead, they serve as the last clean buying opportunity before the final leg higher. In 2017, Bitcoin lost ground in September only to rocket toward $20,000 by December. In 2021, September was red again, followed by a sharp rally that ended with Bitcoin topping near $69,000. Investors who bought those dips were rewarded handsomely. If history rhymes, the next downturn could set the stage for the blow-off move that completes the 4-year cycle. This is why so many market commentators argue the top remains ahead of us in 2025. We haven't seen the euphoric surge that typically caps a cycle. Instead, Bitcoin has consolidated, Ethereum has surged only modestly beyond its prior highs, and altcoins remain subdued. The ingredients for a top, parabolic price action, retail frenzy, and unsustainable leverage simply aren't visible yet. September's weakness could reset positioning and ignite the FOMO that carries crypto to its final peak. Still, the case for a 2025 peak rests on a delicate balance between history and change. Pattern recognition is powerful, but it can also be a trap. Every analyst who swore "this time is different" in the past was punished when the cycle played out as expected. Yet each time, markets themselves have evolved. In 2013, the ecosystem was dominated by retail traders and Mt. Gox. In 2017, the mania centered on ICOs. In 2021, it was DeFi, NFTs, and a wave of new retail adoption. Each cycle had its own distinct character, even as the overall 4-year rhythm held true. The question is whether institutional adoption represents a fundamental enough change to break the pattern. ETFs, pension funds, and corporate treasuries now sit alongside retail traders. Their flows are smoother, their risk management stricter, and their time horizons longer. That could dampen the volatility that usually defines a cycle top. Yet even institutions are not immune to herd behavior. If price momentum accelerates into late 2025, even the most cautious desks may chase returns. That rush could recreate the same euphoric conditions seen in earlier cycles, just with larger sums of money. For now, the simplest explanation still points to Q4 2025. Bitcoin halved supply in April 2024, Ethereum has been breaking resistance, and altcoins are waiting for rotation. Add in September weakness as a potential slingshot, and the stage is set for the familiar finale. Whether the presence of institutions truly alters this script remains uncertain, but markets often stick to the path of least resistance. Until proven otherwise, that path remains the 4-year cycle. Now let's turn to the other side of the debate, the case for an extended cycle into 2026. The strongest argument for a longer cycle comes from the structural shift in who is driving the market. Previous cycles were overwhelmingly retail phenomena. In 2013, it was individual traders on Mt. Gox. In 2017, ICOs and speculative altcoins fueled mania. Even in 2021, though institutions had started dipping their toes, the sharp reversal after November revealed how quickly sentiment-driven retail flows could collapse. The current cycle is different. Spot Bitcoin ETFs, Ethereum treasuries, pension funds, and systematic allocators are now the primary buyers. This shift in participants changes the mechanics of price action in profound ways. Retail-driven markets tend to follow emotional arcs. They climb rapidly, overshoot, and collapse when fear takes hold. Institutional-driven markets, by contrast, tend to be smoother. Profit-taking occurs incrementally. Rebalancing follows predetermined mandates, and positions are spread across strategies with long-term horizons. The result is less frantic liquidation and fewer parabolic blow-offs. That alone makes the argument for a stretch cycle compelling. If the new marginal buyer is patient, systematic, and willing to accumulate for years, the peaks may no longer cluster neatly into 4-year bursts. Consider the role of spot ETFs. These vehicles create steady inflows that act as structural demand. Every time a pension fund, sovereign wealth fund, or registered investment advisor allocates, new BTC or ETH must be purchased from the open market. Unlike speculative retail buying, these flows don't suddenly vanish at the first sign of volatility. They accumulate gradually and predictably, dampening the extremes that previously marked cycle tops. Add to this the emergence of corporate treasuries converting to crypto reserves, and the demand picture looks vastly different from the days when altcoin mania dictated the rhythm. Institutions are simply not playing the same game as retail, and that alone could stretch the cycle timeline beyond the traditional 2025 cutoff. The liquidity profile is also different. With ETFs, investors can enter and exit seamlessly, removing some of the pressure points that cause cascading liquidations in past cycles. Leverage is still present in the system, but it is distributed differently, often hedged across futures, options, and structured products. Retail may still chase the dream of 100 times perpetual contracts, but the balance of market-moving capital now sits with allocators who aren't using those tools in reckless fashion. That smoother behavior translates into cycles that breathe longer, bleed less violently, and take time to play out fully. Another driver of the extended cycle thesis is macroeconomic context. Crypto has become increasingly correlated with global liquidity, and liquidity itself is shaped by monetary policy, fiscal dominance, and political transitions. Right now, the backdrop points toward an environment that can sustain risk assets for longer than the familiar 4-year template would suggest. Consider the Federal Reserve. Jerome Powell's term as chair is set to end in May 2026. With Donald Trump back in the White House, the expectation is that he will nominate a more dovish successor toward the end of 2025. Historically, these nomination periods trigger rallies as markets anticipate easier policy under incoming leadership. When Janet Yellen handed the reins to Powell, the S&P 500 rose into the transition but corrected shortly after Powell took office. A similar pattern played out in the earlier handover from Bernanke to Yellen. The sequence is clear. Optimism into the transition, turbulence once the new chair settles in. If that historical template holds, then crypto could ride a wave of optimism throughout late 2025 and into mid-2026, only encountering serious volatility once the new Fed chair begins their term. That timing lines up almost perfectly with the extended cycle thesis. Rather than topping in Q4 2025, crypto could continue its run until the May-June 2026 period when the chair transition creates the kind of macro stress that typically drives corrections. This dovetails with the broader Goldilocks narrative. Inflation has moderated without collapsing growth, rate cuts are being priced in, and trillions sit in money market funds waiting for redeployment. If those funds rotate into risk assets over the next 12 to 18 months, the crypto market could see sustained support well into 2026. Global liquidity data reinforces this point. Central bank balance sheets, treasury flows, and global lending standards all point toward a continued expansion phase rather than a contraction. The Treasury General Account is being refilled, banks are easing lending standards, and though loan demand hasn't surged yet, that slack represents dry powder waiting to ignite. Historically, global liquidity leads market moves by 6 to 8 weeks, and current projections show it rising steadily. Unless a major shock interrupts, the macro setup is simply not aligned with a Q4 2025 termination. Instead, it looks like risk-on sentiment can persist into the following year, delaying the cycle top. Even inflation, the perennial threat, may play a different role this time. Powell's Jackson Hole comments hinted at a tolerance for inflation above 2%, with the possibility of adjusting the target to 3%. That kind of regime change essentially signals a willingness to inflate away debt, creating a favorable environment for hard assets like Bitcoin and Ethereum. Combine this with fiscal dominance, the aggressive spending and bond issuance from governments worldwide, and the case strengthens further. More debt, more liquidity, and more tolerance for inflation all equate to stronger tailwinds for crypto. It is difficult to reconcile that backdrop with a sharp cycle termination in late 2025. Perhaps the most compelling evidence that this cycle may run longer lies not in macro forecasts or institutional flows, but in what the market has not yet displayed. A true cycle top requires specific ingredients, and so far they are missing. First and foremost, euphoria. Every prior peak was characterized by manic behavior. In 2017, ICO white papers raised billions overnight. In 2021, NFTs and meme coins dominated headlines, with retail investors piling in at unsustainable rates. Right now, the mood could hardly be described as euphoric. Bitcoin's fear and greed index has spent more time in neutral than in extreme greed. Every 5% dip still prompts cries of cycle top, a sign of lingering caution rather than mania. Altcoins remain fragmented, with liquidity concentrating around Ethereum rather than flowing indiscriminately into every token. Meme coin volumes, while recovering, are nowhere near the absurd highs of prior peaks. Simply put, the wall of worry is still standing. Second, a blow-off top. In each previous cycle, parabolic price action signaled the end. The climb was too fast, the slope too steep, and the reversal inevitable. That kind of vertical move has not yet materialized in 2025. Bitcoin is consolidating near $105,000 to $115,000. Ethereum has broken to new highs, but only modestly, and altcoins are nowhere close to their speculative extremes. Without that parabolic surge, it is hard to argue the cycle is over. Third, stablecoin stagnation. Historically, stablecoin market cap growth has acted as crypto's internal money supply. Expansions fuel rallies, stagnations precede tops. At present, stablecoin supply continues to climb, suggesting dry powder remains in the system. Until that metric flattens, the tank is not empty. Finally, the role of long-term holders provides insight. On-chain data shows that some early Bitcoin whales are selling into strength, transferring coins from wallets untouched since 2011 or 2012 into ETF custody. While this creates short-term headwinds, it also signals distribution to new long-term holders. A cycle doesn't typically end until these transfers have fully played out and new capital is exhausted. At present, we are still in the middle of that process, not at its conclusion. Taken together, the absence of euphoria, the lack of parabolic moves, continued stablecoin growth, and ongoing distribution all point to a market that still has room to run. The peak conditions are not yet visible, which aligns with the idea of a cycle stretching into 2026. What do you think? Are we watching the final chapter of this bull run unfold, or is the biggest move still waiting just around the corner? And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.